Good morning, this is Rich Posson for the Critical Point podcast. It is April 2nd. Today we had the initial jobless claims report come out over 6 million when average analyst guess was in the 3 million range, and you may recall last week we had 3 million. So gigantic numbers, huge. So the markets are a little bit soft on the stock side, interest rate side. We do have crude oil up this morning off of Trump speaking about Russia and Saudi Arabia, that the supply war, price war may be ending soon. So we have bond prices up this morning because of those lower rates, because of the greater job loss. Okay, so what does this mean for the model in terms of calculating the trends, forecasting the trends? Well, until this high is taken out as of week of March 9, we still believe a level 1 top occurred, and that may even be a long-term top, although we have multiple scenarios when it could take months to find a long-term top in bond prices and therefore a related bottom in interest rates. And by the way, when we do find a long-term bottom in interest rates, we're going to have a super cycle low dating back decades. Okay, so at any rate, we turned bearish and said the price should work lower into the week of April 13th to May 4th. And we can see the market, however, has extended an L3 trend inside these larger level 1, level 2 trends. We think this is no more than a secondary test, kind of a knee-jerk reaction. We think it should top this week. So what we will be watching for is a violation of this week's low at 138, 110. This is based off the weekly nearby contract. It's currently showing as June at 139.040. So we see that, and what could occur here is there could be a level 3 low this week as well as a level 3 top. This would create a sequential flip when the next level 3 trend will spend most of its time going down versus this trend when most of the time was spent going up. So this suggests we could have 2 weeks of decline in bond prices and therefore pop in interest rates. Now, what would go wrong or could go wrong? And the answer is if the markets really feel like they didn't dial in all this bearish negative economic impact relative to the virus impact, then we may see an extension here going beyond even this L1 top. It could go out here to, say, week of May 11th. We would probably revise it, move the level 1 out, and still call for a level 1 top and first chance for some kind of long-term top. We revise this L2 to become an L1 because ideally you shouldn't really have 2 L2 tops between L1 tops. Okay, it's rather rare to occur, but we felt there was a rare set of circumstances, and the overall looks suggested that we were looking at a bigger cycle this time around. So yes, there are scenarios saying this bull market can last for a while yet. There's even scenarios saying this particular uptrend from November could extend into May. What would occur if that were to be the case? This level 1 low due in a few weeks here might not cause such a decline in bond prices. It would come in just ahead of a level 1 top, creating a far more important sequential flip than what we just spoke of on these little fluctuations, these level 3s. That could lead to as much as a 2-month decline in bond prices, and we would think that would increase odds for perhaps a long-term top. So bottom line, there is an alternate scenario for those that want to be bullish. But I think you have to, I think I would go with the idea that we just don't want to see this week's low violated, especially on a closing basis, if you're trying to trade for that more bullish scenario. Now, we do have a weekly stochastic is trying to turn bullish this week. Maybe that can mean there's some kind of extension and lingering momentum, but you could argue it's only trying to get started. The overall trend is actually down after being considerably overbought. Bottom line is we think bond prices are going lower in coming weeks, but we fully understand that there is an alternate scenario suggesting there's risk of an early call. Hope this has been some help. And as always, manage your risk relative to the analysis of others and your own. Thank you.